Hello, assalamu alaikum to all of you, and a very good morning from my side. My name is Amar Sarwar, and today is day 4 of the practice to pass session of paper FA. So, we are going to start a session, and today we are going to discuss the topic that is ratios analysis. Ratios is actually a topic that is related to the performance measurement of the company. The ratio is one of the tools through which we measure the performance of the business. So this topic is very important for financial accounting and the next paper, that is financial reporting, in which examiner might ask you a question in which you will be given a situation in which a particular ratio is increasing or decreasing, and you need to comment on that what does a gross profit increase means, or what does a return on capital employed decrease means. So you should know the reason behind the movement of each and every ratio. So when we talk about the ratios, we measure the profitability, or we measure the performance of the business into 4 dimensions. The first one is the profitability, in which we measure the performance of the business in the area of profitability. We measure the potential of the company to earn profit. So how much profit the company is earning and its future potential. We talk about the liquidity of the business, how the company is managing its cash. This is all about the profits. This is all about the cash, how the business is managing its cash to pay off its short-term liabilities. So liquidity is measured to retain the company and from bankruptcy, the risk of bankruptcy. That's why we measure the liquidity position. So if the business is not liquid, then it may not be able to pay its liabilities on time. So at that time, the business might be bankrupt. Then we have a fund management. Fund management involves the managing of 3 things, that is stock, receivables, and payables. So how the business is managing its fund into these 3 items: stock, receivables, and the payables. And the last one is gearing. Gearing will calculate you the loan burden of the company and the level of the geared, or the gearing means the level of the loan burden on the company. So how much company is under the loan of the loan provider. So this is actually related to the shareholders, because whenever the company has increased its loan, it will increase the finance cost and it will reduce the profits. So whenever the profits reduces, it will affect the dividend of the shareholder. So shareholders are more happy when there is a reduction in the gearing in totality, because shareholder will be risk-free if the company has got no gearing. But some may say that the gearing is beneficial for the shareholder in the sense that it will create a fixed cost for the company. So if you are earning a huge amount of the profits, so it will only be a fixed cost for the addition for borrowing additional amount. So you don't need to share your profits with the other shareholders. So it's beneficial for a company to take the loan and pay the finance cost, which is the fixed cost. And again, fixed cost is tax allowable, so it also provides tax benefits. So these are the areas in which we measure the performance of the business. But remember this point that whenever we are going to measure the performance of the business or performance of anything, we need to have a base for the comparison. You cannot measure the performance in absolute terms. So it will always be a relative term. Like you can measure the performance of the current year with the last year position. This is called a comparison with the previous year. Or you can compare your data with the competitors' data. It could be your industry average. So there must be some basis on the which you conclude the performance of the company. So let's start. Now remember this point that this topic is very important for section A. Most of the questions you can expect 4 to 5 questions in section A from this topic. Now starting from the first one, that is the profitability. So whenever we talk about the profitability, the first ratio that comes in our mind is actually the gross profit margin. Whenever you see the word margin, that means sales should be in the denominator. So gross profit margin means gross profit upon sales multiplied by 100. But if the question tells you to calculate the gross profit markup, then it means that you need to show the cost of goods sold in the denominator 100. So these are the basic formulas for the gross profit. Now what is the meaning if there's an increase in the gross profit? So the reasons for the movements. So whenever there's a change in the gross profit of the business, there could be a change in the sales prices. Like if you increase the sales price, it will improve the gross profit of the business. But remember this point that some of the inventory or the products might be price sensitive. So when you increase the sales price, it will impact on the volume of the product. Like there are a lot of students who are doing ACCA across the globe, and they are paying a fee for each paper to ACCA. But if ACCA has increased the fee 3 times, as compared to the current fee level, then it will definitely increase the profits for the business or ACCA, but it will definitely impact on the volume of the students who took the examination. So currently, if the fee level of each paper is assuming 10,000, but if you increase the fee level to 30,000, So there is an increase in the fee by 3 times. It might not be possible for some of the students to arrange this type of fee or to manage the fee of the examination on an overall basis. So it might impact on the volumes. So opposite is the case when there is a decrease in the sales price, it will reduce the gross profit, but it will definitely increase the volumes of the business because whenever you see a discounts or the reduction in the prices, then definitely the demand will increase for that product. Changes in the sales mix means you are selling more profitable products in the current year as compared to the previous year, and when there is a lower sales of less profitable products. Suppose if you have got two products, one has got the gross profit, is giving you the gross profit of 60%, and the second one is giving you the gross profit of 20%. So if you sell this product A, more in the current year, then it will improve the gross profit of the business on overall basis. But if you sell this product more in the current year as compared to the previous year, then it will definitely reduce the overall gross profit of the business. Similarly, if we can affect the purchase cost of the business, if you can reduce the prices, then this will definitely improve on the gross profit. But you should remember this point that if you're reducing the prices, it should not affect the quality of the product. Because if it is going to affect the quality of the product, like you're going to use a cheap material, cheap labor cost, unskilled labor, then the cost might be decreasing in the short term, but it will impact on your business in the long term. So for all the ratios, you should know the current impact and its future impact. Similarly, the change in the production cost. If you will be able to reduce the production cost of the business, then it will definitely increase the profits. So these are the reasons for the changes in the gross profit ratio. The next one is the operating profit. As we all know that the gross profit will be derived from, or is derived from, operating profit is derived from the gross profit. So the same can be used for commenting on the operating profit. If the examiner has asked you directly the operating profit margins are in the gross profit, so the reasons for the gross profit can be used for operating profit margin as well. Other factors may include any factors above that affects the gross profit, the changes in the administration expenses and distribution costs. So if you'll be able to reduce the expenses impact, it will affect the profits. So the profit will be increasing. But remember this point that whenever you are going to reduce the expenses, you need to see whether you are cutting down the expenses or you are managing your expenses efficiently. So if the company is managing the expenses efficiently, then it will definitely improve the profitability in longer run and shorter run. But if you are cutting down the expenses, like you are reducing the marketing budget or you are reducing the number of employees in the company, then it will affect your business in the longer run negatively. So the profit percent, the formula that we used for this operating profit margin means profit before interest and tax divided by sales into 100. So this was the formula that we use for operating profit margin. The next one is return on capital employed. I want all of you guys to participate in this process and tell me the formula for ROC. Can you guys tell me the formula for ROC, return on capital employed? The formula should be PBIT, profit before interest and tax, divided by capital employed into 100. This is one of the formula that we use for the calculation of ROC, or ROC is a multiple of asset turnover ratio into operating profit ratio. Asset turnover ratio into operating profit ratio. Now, the first reason behind the change in the ROC could be when there is an increase in the PBIT, there will be an increase in the ROC. The increasing ROC means the business is earning more profits as compared to the previous year or competitor with comparison to in comparison to their capital employed. But if there is a reduction in the capital employed, then this will also affect the ROC. But you cannot say that there is an improvement in the overall return on capital employed of the business because the profit is the same, but actually the capital employed is decreasing. So whenever the capital employed is decreasing, the ratio will be actually overstated. So you can say that it is an artificial increase or the ratio is overstated. Or you can comment on the asset turnover. Asset turnover means the potential of the company to earn the revenue, and it is about the profits. So if both operating profit ratio and the asset turnover is increasing, then it will affect the overall return of the business. Or if it is decreasing, the responsibility will be on the asset turnover or the operating profit ratio. So the who will be responsible? Reasons for the movement in the asset turnover. The first one, the movement in the profitability. Second one, operating profit ratio. Changing the more efficiency of the profitability. Because the formula that we used here is used for the comments. Asset turnover is having a formula of revenue upon capital employed. So in this ratio, we actually we are measuring the potential of the company to earn revenues in comparison with the capital employed that the business has invested into business. So definitely the reason must be revenues and capital employed. One of the formula that we use for the capital employed is total assets minus current liabilities. So if there is an increase in the asset, it means there is an increase in the denominator. That will affect the asset turnover in the downward manner. Increase or decrease in the working capital. Working capital means current assets minus current liability. which is also a part of total asset minus current asset. So if there is an increase in the working capital, that means it will increase the capital employed, and definitely it will affect the asset turnover. So in the examination, you will be given any type of ratio, and you need to comment on that. And these are the possible comments, valid comments, or there might be some invalid comments. So sometimes you need to select the valid comments, and sometimes you need to select the invalid comments for the movement. So let's start with some practice. Now this one is the question for you guys, in which you are required to calculate the profitability of the business. So required all the four formulas, four ratios for both 2005 and 6. So this data is for 2006 and this data is 2005. I'm giving you just 2 minutes to solve it. Yes, we will share. I will share the handouts in the group. You don't need to worry about it. So it will be the I will share it on the old group. There is no new group right now. So you don't need to worry about the handouts. Or if I miss to share the handout, you can remind me on my number as well, or you can ask me directly for the handouts. That's not a big issue. Now the first ratio is gross profit margin, gross profit upon sales, 7,300 divided by 27,000. So for 2003, the gross profit ratio will be 27%. For 2006. For 2005, the formula will be 6,900 divided by 24,000. It is now 28.75. So one of the reasons that you can conclude at this point of time that from the previous year to the current year, the company might reduce its selling price from 28.7 points to 27%, and it will improve the overall volume. That's why that's one of the reasons that there is an increase in the revenue over the period. That could be one of the reasons. Next thing is the operating profit ratio. So whenever we are talking about the operating profit ratio, we always take the profit before interest and tax, which is 5,000 divided by 27,000. So in 2006, the operating profit margin is 18.5%. And in 2007, the profit is 5,000 divided by 24,000. So it will be 20.83%. So on an overall basis, the profitability of the business is going down. So one of the reasons that you can use is is actually the impact of the gross profit. As the gross profit is decreasing, therefore the net profit is also, the operating profit is also decreasing. Or the company has managed to, the company has increased its expenses, in fact. So one of the reasons could be the increase in the expenses. You can see previously we have got 1,900 of expense. and now it's 2300. So the percentage increase in the expenses, if it is more than the percentage increase in the revenue, then definitely it will affect the overall profitability of the business. So these are the two important ratios that I have calculated. Now on the next ratio that we use should be ROC and asset turnover. Now talking about the ROC, return on capital employed, PBIT upon capital employed. So whenever we talk about the capital employed, it must include the equity and the non-current liability. So the total equity of the business is 19,100 plus 11,000. So the total equity should be 19,100 plus 11,000. It should be 30,100. So when you calculate the percentage of ROC, the percentage will be 16.6% for 2006. 16.6. Return on capital employed means the company is generating 16.6% profits based on the capital employed in 2006. Whereas in 2005, PBIT divided by capital employed, which will be 24,200. So there is an increase in the capital employed over the period, but there is no substantial increase in the profitability. That's why it will definitely impact on the ROC. So 5,000 divided by 24,200, we got the value of 20.6. So you can clearly see the question that there is a decrease in the ROC over the period, and which could be due to the increase in the capital employed, because the profitability is same in both the years, but there is a substantial increase in the capital employed, which ultimately affects the overall ROC of the business. Finally, we have got the asset turnover. Asset turnover for 2006. Revenue 27,000 divided by capital employed of 30,100. For 2005, it will be 24,000 divided by 24,200. So this is how we can calculate percentage. 30,000, 0.897 So for 2005, the formula is 24,000 divided by 24,200. 99.17. So previously we are generating revenue based on the capital employed of 0.99 times of the capital employed, but now it's 0.99, which is just 0.99. But now in the current year, the company has generated less asset turnover because there is an increase in the capital employed, but there is not a corresponding increase in the revenue. So the percentage of increase in the revenue is lesser than the percentage increase in the capital employed. So that's why overall, on overall basis, the asset turnover is reducing. So that's great. Like this is how we have calculated the profitability. Now the next ratio is the liquidity. In the liquidity ratios, I want you guys to write the formula for the current and liquidity ratio. Box. So for the current ratio, the formula is current asset I need to select the pen first. Current asset divided by current liability. So for the current ratio, the formula is current asset divided by current liability. And for the quick ratio, the formula should be current assets minus inventory stock divided by current liability. So current asset minus stock divided by current liability. The ideal for this ratio is 1:1. So if it is less than 1:1, it could go below 1, or the maximum range is 0.8:1 to 1:1. And for the current ratio, the range is 1.5:1 to 2.1:1, 2:1. So if these ratios are at the ideal position, that means that the company is managing liquidity very efficiently. So the reasons could be due to the increase or decrease in the cash balance, increase or decrease in inventory, increase or decrease in receivables, and then increase or decrease in the payables. So these are the factors that affects the overall working capital of the business. So that's we need to keep an eye on the working capital of the business, that how the business is managing the working capital. So if the current ratio is 1:1, what does it mean? So for a liability of $1, we only have current assets of 1 rupee. That is alarming situation for the business because the current assets might be in the form of stock, in the form of prepayments, in the form of receivables or cash or any other. So that's why we always assume that in comparison with the current liabilities, current asset must be double. That's why the ideal situation is 2:1. But in some situations, it can till go back to 1:5:1. So that's the formula for current ratio and quick ratio. If the both ratios are increasing substantially, that means the business is misusing its resources because we don't need to have a huge amount of the capital investment in the working capital. Similarly, if both the ratios, current ratio and quick ratio is decreasing, that means there is a sign and or risk of liquidity problem. So if both the ratios are decreasing, that means that the business is having a liquidity issues. If both the ratios are increasing, that means the business is having a misuse of funds issue. Now the next thing that we have is inventory turnover. Inventory turnover in days can be calculated as inventory in the numerator divided by cost of goods sold multiplied by 365. This is called inventory turnover in days. In times, the formula will be cost of goods sold divided by inventory. This will give you the answer in times. There is no 365 in this one. So if there is an increase in the inventory turnover in days, like suppose previously we have got 30 days and now it's 40 days. What does it mean? So previously we are selling the inventory from the warehouse after 30 days and now it's 40 days. It means my inventory is more slow moving than the previous year, or that this change might mean that there is a lesser demand of our products in the current year, which will ultimately increase the holding cost of the business, in fact, and definitely it will also increase the risk of obsolescence or the risk of inventory damage. I want to take the snapshot. This was the last slide. So the reason for the movement would be improvement, deterioration in inventory controls, obsolete inventory, increase on level of the inventory. to facilitate marketing and selling campaigns. So there could be reasons for the increase in the inventory turnover or decrease in the inventory turnover. Now, receivables collection period. I want all of you guys to write the formula for the receivable collection period in days and both in times. Can you hear the voice? Okay, that's great. Now the receivables collection period, again the formula could be written in times or in days. The most common in the days. So when we talk about the formula, it will be receivables in the numerator. Denominator, in denominator we need to have the credit sales into 365. So suppose previously we have got 40 days for the receivable collection period, and now it is 65 days. What does it means? There is an increase in the time period or the collection period that shows that the business is receiving the cash previously in 40 days from the customers, and now they are giving to make the payments in 55 days. So definitely this increase is not a positive sign for the business, but it could be due to that the business has increased the credit facility for the customers. Like previously we are giving the uh, goods on the credit terms for 40 days, and now we have increased till 60 days. So this could be the reason. Or the reason could be the deterioration in the credit control department, improvement of the credit deterioration. So the increasing in the receivable collection period in days shows a deterioration in the credit control department substantially, because they are not receiving the payments on time. Positive thing is we might extend the credit terms in order to increase the sales to the customers, or when there is a decrease in the receivable collection period, that might be the indication of irrecoverable bad debts. That company has write off the bad debts amount substantially, then it will affect the receivables and ultimately affects the receivable collection period. But when we wanted to write this formula in times, the formula will be credit sales in the numerator and receivables in the denominator. This will give you the answers in times. So for the receivable collection period in days, it's better for the company that the receivable collection days is reducing or increasing in terms of in times. Like suppose previously if the answer is 5 times and now it's 8 times. So previously the customer is paying 5 times a year and now they're paying 8 times a year. That means your performance better for the credit control department. But if the case is opposite, that previously we have 8 times and now it's 5 times in a year, then it will definitely impact on the receivables period. Now moving forward towards the creditors or the payables payment period. When we talk about calculating this payable payment period in days, formula should be so when we talk about in days, in the numerator, creditors will come in the numerator divided by credit purchases multiplied by 365. But yes, you can use the cost of goods sold in place of the credit purchases for this payment collection period. So increasing the payable collection period is beneficial for the company as it is a free source of finance, but it should not, the increasing should not affect the relationship with the supplier who might stop delivering you the goods. It's better to maintain a reasonable level of creditors payment period. It might be because of the new credit arrangements, new supplier, higher debt indicate inability to pay, increasing payment uh, methods, increasing payment period may give an entity a reputation as a poor player. It will affect your goodwill as well if your payable collection period is higher. But in at the end, every business calculates its working capital cycle. So when we talk about the working capital cycle, it should include the inventory turnover. Sorry. Inventory turnover in days plus receivable turnover in days minus payable turnover in days. So the final answer of this working capital cycle or cash cycle matters a lot. Like if your working capital cycle has got 30 days and other is having a time period of 50 days. So the whole idea is that your investment is stuck up in inventory and receivables and payables and release after 30 days. But now it will take 50 days for the business to to pay back its amount that has invested in inventory. So I think it's bad for the company if the overall cash cycle is increasing. So it's very important for the business to maintain its cash cycle and maintain the cash working capital cycle. So it should be decreasing over the period. So let's do some practice. So now this is the example for you. You guys are required to calculate the liquidity and working capital ratios for the 2 years, 2005 and 6. I'm giving you 5 minutes to calculate both the working capital and the, the working capital and the liquidity ratios for 2005 and 6. 5 minutes. I'm giving you 5 minutes to solve it. Yes, I have given you some time to solve this question. Now it's my turn to solve. The first one is the liquidity. The formula should be current asset less divided by current liability. 2006, 2005. So the current assets in total that we have is 8,600 divided by current liability of 4,100. For 2005, it's 8,200 divided by 3320. 8,600 divided by 4,100. So it's approximately 2.1 ratio 1. So it's on the safer side. 8,200 divided by 3320, approximately 2.5 ratio 1. So on overall basis, the liquidity position of business in both the years is better. It decreases in 2006, but it's still better because it's around the ideal ratios, which is 2 ratio 1. So still the liquidity is better in a better position. Now, for the quick ratio, you need to have a formula. You need to use the formula of current asset minus stock divided by current liability. So in the denominator, 4,100 and 3320 will appear. But in the numerator, you need to deduct the closing stock from the current assets. 8,600 is the current assets value total minus inventory of 5,100. The amount will be 3,500 for similarly 8,200 minus closing stock of 4,600. The amount will be 3,600. Calculating the current ratio of the business, 3,500 divided by 4,100, we got the value of 0.85 ratio 1. Still, the liquidity position is better because the lower range is 0.5 ratio 1. So it's more than 0.5 ratio 1. So that shows that the current and the quick ratio position of both the business in 2006 is better. Talking about 2005, 3,600 divided by 3,320. So it's 1.08. Again, it's around the ideal ratio. So that's why it's perfect. So on overall basis, the liquidity position of the company is good. Now we are going to calculate the working capital ratios. The first one is inventory turnover. 2006 and 2005. Inventory turnover in days. In the numerator, we need to show the inventory, which is 5,100 and 4,600. In the denominator, we will show the cost of goods sold, 19,700 and 17,100. and 365 will be used for both formula, both the years. We got the value of, so for 2005, 4600 divided by 17,100 multiplied by 365. So it is actually 98 days after which the inventory was sold from the warehouse. So now it's 94 days. So previously your inventory was selling after 98 days, and now it was selling after 94 days. So the decrease in the inventory turnover in days is beneficial for the company because we are selling the goods in lesser time. That will reduce the risk of obsolescence and deterioration, and definitely it will reduce the holding cost of the business. So it's better for the company to reduce the inventory turnover days, in fact. Now, receivable collection period. In the numerator, we need to show the receivables. In the denominator, we should show the sales. Multiply by 365 for both the years. So 2700 divided by 24,000. So previously it was 41 days after which you are receiving the payments from the customers, and now it's 44 days. So previously it was 41 days that after which we are receiving the payments, and now it's almost 44.6, means approximately it's 45 days. The increasing in the receivable collection period might be due to the poor performance of the credit control department because they are not collecting the payments on time, or it could be the company has increased the credit period for the customers. Payment period. In the numerator, you need to show the payables. In the denominator, if the purchases was mentioned, not mentioned, you can use the cost of goods sold. So now here we have got the formula. 2400 divided by 17,100. So it will be 51 days. So previously you are paying your creditors after 51 days, and now it's Now it's 59 days. So we are delaying in the payments to the creditor. It's good for the company because it's a free source of finance. But you should remember this point that it should not affect your terms with the supplier who will stop providing you the supplies. So delaying in payment to the creditor is good for the company, but should not be, it's not good for the company if in fact affecting the terms and the overall business of the goodwill. Now the last ratio that we are going to discuss is the position or gearing. The formula for the gearing is, one of the formula is debt equity ratio. In the numerator, you need to report the debt, and in the denominator, you need to report the equity. When it comes to equity, that includes all share capital and reserves. So debt upon equity is one of the formula. The other formula is debt upon debt plus equity. What does high gearing means? High gearing means large proportion of fixed return capital, greater risk of insolvency, proportionately greater returns to the shareholders if the profits are growing. Low gearing means scope to increase the borrowings potential for new projects. Borrow more easily perceived as a low risk. So gearing might increase whenever there is a, the simple thing is when, if you are measuring the debt equity ratio, the numerator we have got the debt and the denominator we have got the equity. So if the debt is increasing, that means the ratio will increase. If the equity is increasing, that means here the ratio will decrease. So that's the point. One more formula is the interest cover. The formula is PBIT upon interest expense. Interest cover in times is 5 times previously. Now it's 8 times. This shows that the interest cover of the business is increasing over the time period. That means the business is on the safer side because in comparison to the interest expense, your profit is 8 times higher. So the higher the interest cover, the more strong the company's profit will be, or the company will be in the better position. So now we have covered almost all the questions. Now let's do attempting these questions because they are examination related questions. So just read this one. Now the name of the question is Zina. This one is the question. You are required to tell me the answers A, B, C, D. You have got 4 options. and you need to select the one. Write your answers in the chat box. Now the current ratio in this question is 1.5 to 1.2. The current ratio is decreasing, receivable collection period is increasing, payable collection period is decreasing, and inventory turnover days is increasing. So that's the data that we have been provided. Which of the following statement about the Zena company is correct? Zena is suffering from worsening liquidity position in 2009. I don't think so. Okay, the position is worsening because we are moving from 1.5 to 1.2. Yeah, you can say it's worsening because it is decreasing the from minimum benchmark. This could be one of the answers. We are receiving cash from the customers more quickly. No, we are not receiving the cash more quickly. Zina is taking longer to pay the supplier. No, we are taking less time to pay the supplier. Zina working capital and the liquidity has improved. No. So the answer is A for this question. I think we have already covered. We have covered this one already. Now, calculate the answer of this question. Please solve this question and reply your answers in the chat box. Is it done? Is it A or C? Yeah, it's C. Return on equity to the shareholders, capital employed. So the formula should be profit. Now let's do solving this question. Yes, the return on equity, the formula will be profit after tax divided by capital employed. Now the right answer for this question is A. The formula that we used will be the profit after tax divided by profit after tax divided by shareholders equity. This 22 divided by shareholders equity is 500. Percentage will be 4.4%. Answer will be A. Solve question number 65 and please do give your answers in the chat box. Question number 65. Current ratio. The current ratio is 1390 divided by 420. Second one is 420 divided by 420. It will be 1:1. And 3.3. A higher current ratio and an ideal asset turnover ratio. An ideal current ratio, no. A higher current ratio and a low. So the right answer is A for this question. Very good. Now question number 66 and 67. Wonderful. Now let's do these questions. In October 2009, the gearing ratio compared to 31st October was rising, resulting in the greater risk to the shareholder. Rising, fallen remain the same. So if we just calculate the gearing ratio, so if it is debt upon equity, the formula will be 20 upon 15 plus 3 plus 22. So it's 20 divided by 40. So it will be 50% for 2008 and 30 plus 18 plus 12, 57. So it will be 70%. So the right answer should be, for this case, should be A, because the gearing has increased over the period, with the greater risk to the shareholders. Annual sales revenue of an enterprise is 235,000, including the sales tax of 17.5. Half the sales are on the credit terms, half of the cash. Receivable in the financial statement is 23,500. So you need to calculate the receivable collection period. The formula is closing receivables divided by credit sales. So the first you need to calculate the actual sales. So the actual sales of the business is actually 2 lakh, because 17.5% is the sales tax figure. So when you remove the sales tax amount, the total sales of the business is 2 lakh, out of which 1 lakh is on credit terms, 1 lakh is for the cash terms. So only credit sales will be used for the calculation. So 23,500 divided by 1 lakh multiplied by 365. So the answer will be D. So if you have any doubt about these two questions, please do ask it immediately. No questions? Okay. So we have successfully completed this topic, ratios. So the other question that is left over is your home assignment. So now we are taking a break of 15 minutes, maximum till 12. And after that, we will be covering the topic cash flow statement. Let's take a break. Okay, welcome back after the break. Let's start with the new topic, that is cash flow. Now, according to IAS 7, cash flow statement must have three activities. The first one is the operating activity, the investing activity, and third one is the financing activity. So there are three types of activities according to IAS 7. So the financing activity is related to the long-term sources of finance of the business. Long-term sources of finance means the movement in the equity of the business and the liability. Investing activity is all about the movement in the non-current assets and investments. And operating activity is about the trading and operations of the business. So there are three types of activities: operating, investing, and financing. So operating activity is about the trading and operations of the business. Investing activity is about the movement in non-current assets and investments. And financing activity is about the movement in the long-term sources of finance. So here we have got the format for the financing activity. It includes the cash received from the issue of shares. Always remember this, that whenever we are going to take the cash from the issue of shares, you need to add the changes of the share capital and share premium account. Receive the loan notes and the repayment of the loan notes and dividend paid. So this is the basic format that we need to memorize for the financing activity. Now let's solve this question in which you are required to calculate the cash received from the issue of shares. Please do calculate this point. Please solve this question. You guys are required to calculate the cash received Cash received from the issue of shares. Okay. When you see an increase in the share capital from 150,000 to 180,000, so there is a change of 30,000 the share capital, and there is a change of 540 to 40, from 405 to 540. So there is a change of 135 in the share premium account. So the total change is now 165,000. So the total cash the company has received from the issue of shares is 1,65,000. Is it clear? Now let's do another question in which you guys are required to calculate the cash received or cash paid related to the long-term borrowings. Now, let's solve this question. Company has repaid the loan of 300,000. So there's a negative cash outflow of 3 lakh. And at the same time, borrowed on borrowed a loan of 8% loan. So the net amount is the company has borrowed is 1,20,000. So net cash flow is 1,80,000 negative. I hope it's clear now. Now, one of the point that you should remember in finance when you're calculating the financing activity, that examiner might not give you the retained earnings, the dividend paid all the time. So you need to calculate the dividend from the formula retained earnings openings plus profits minus dividend is equals to retained earnings closing. So from this formula, you need to calculate the dividends paid. So I'm giving you 1 minute to solve this question and calculate the dividend paid. Okay, the retained earnings at the start of the period is 476,400. Profit for the year is 117,945. Dividend is here, retained earnings at end is 532,500. So when we are calculating this, so retained earnings at start is 476 400, and retains attendance 532 500. Five thirty two 500 minus 476 400 minus plus 117 945 532 500. So there is a dividend paid of, from this equation, 845. That's the dividend paid. So sometimes the dividend paid is missing, so you need to calculate the dividend paid from this equation. Now talking about the investing activity is about the purchase of non-current assets during the year, the sale of non-current assets during the year, any sort of income that we get from the investments. Then we have interest received, dividend received, or any type of income that we have received during the year. So all types of incomes should be adjusted in the investing activity. Now here you have got the format for the T account of net book value, in which you will be given opening balance, closing balance, depreciation expense, disposal, revaluation gain, and the missing figure is the cash paid. The examiner might ask you the question in which you are required to calculate the cash paid for the purchase of non-current assets. So this could be identified from this net book value T account. So now here is a question for you, in which you guys are required to calculate the cash paid for the purchase of non-current assets from this T account. This was the format. You only have to input the data into this format and you will get the final values. Here is a question for you. Please do attempt it. Now let's solve this question. You need to prepare the key account having an opening balance of 33,800. The closing balance is 43,200. Depreciation is 7,200 that was charged. And the mains sold an item of plant with a carrying amount of 900. Disposal was here. There is a revaluation surplus of 5350. So everything is placed rightly in the key account. And then finally you need to calculate the closing balance. 43,200 plus 7,200. $33,800. The amount is 17,500 missing figure. So this is my cash paid for the purchase of non-current assets. The one is the cash received. So you have got an asset having a carrying amount of 900, was sold at a profit of 1400. That means it was sold for 1300 in fact. So this is my outflow. It should show on the negative side, and this is my inflow, which will be shown on the positive side. Now another question for you guys. I want all of you to attempt this one. It's your home assignment. Please take the snapshot of this picture of this slide. Now this is your home assignment. Now moving on toward the next question, that is operating activity. In the operating activity, it's very simple to handle the operating activity because you only need to follow a specified format, starting from the profit before taxation. Then depreciation, which is non-cash item, should be added back. Profit on disposal is deducted. Loss on disposal is add back. Finance costs add back. Interest receivable less. Increase in inventory less. Increase in the receivables less. Increase in the payables add back. The net cash flow is the cash generated from operations, and then you need to deduct the interest and tax amount. You will get the amount of cash flow from the operating activity. So this is the first format I need to follow. Now, please do attempt this question based on this format. I hope it's done now. So here is the format for you, and it's the data. You only need to input the data in this format, and you will get the answers. Interest payable T account is available here. The net amount is charged in the finance cost. Then this return equation is used to calculate the dividend paid during the year. This was a tax account. It has an opening and closing balance, that the cash paid to the taxation authorities, and this is used to calculate the tax expense and tax paid. Anyone could be missing in the exam. But this is a direct method for the cash flow, in which you need to show the total cash received from the customers, total payment made to the suppliers, and total made for the expenses. This is called cash flow from operations. So here you can see the total cash the company has received is 99,000. Total payments made to the supplier is 40. Then we have paid to the supplier 45,000, and then we have paid to the expenses. For the expenses, it will be 31,000. So this will be the net cash flow. Now, this is the final format that includes operating, investing, and financing activity. After attempting all these three activities, we calculate the net cash and cash equivalents, in which you need to add the cash and cash equivalent at start, and your answer should reconcile with the balance sheet figure. So we have covered, Alhamdulillah, the cash flow topic as well. So by tomorrow, I want you guys to please do attempt all these topics from the Kaplan BB Kit. And tomorrow we'll be focusing on the topic uh, that is IFRS. So now you're ready to attempt the questions from the Kaplan BB Kit. So do attempt the questions and the handouts which I have shared with you guys. And you will also see some questions from my handout. And we have covered, Alhamdulillah, income records, company accounts, consolidation, ratios, and cash flow. So tomorrow we'll be focusing on IFRSs and framework, or any topic related to F3 in which you have some issues. You can tell me. I will cover it in the next lecture. So if you wanted to ask any question about today's lecture, you can just write it in the chat box. You wanted, if you wanted to give the feedback about this lecture, you can give the feedback in the section of chat box. And inshallah, we will start our next session by tomorrow, same time, from 10 a.m. to 1 p.m. So 3 to 4 minutes left. If you have any questions, please do ask immediately. Otherwise, we will close this practice to pass session for today, because I have covered almost all the areas which is on the target for today. So thank you so much for the time. Inshallah, we'll be meeting tomorrow. And if you haven't joined the WhatsApp group, please join the WhatsApp group and ask any type of question that comes in your mind. Thank you so much. Allah Hafiz.